Welcome to this conference. I'm very happy to see that you have turned up again in large numbers today for today's webinar of the Belgian Financial Forum, with a special focus on financial stability issues related to the COVID-19 pandemic. It's true to say that the coronavirus crisis reminded us of the unexpected shocks that can occur in societies, in economies and financial systems, although some can rightly claim to have warned us in advance. Anyway, this crisis not only laid to waste previous expectations and plans, it also required immediate and sometimes forceful reaction in order to assess the implications and contain the potential negative spillovers. The start of the pandemic crisis in March 2020 definitely ranks among one of the most far-reaching global and systemic events in history. It put the resilience of our societies, economies, and financial systems to the test. It was also a test of the resilience and agility of all kinds of policymakers, including those in charge of ensuring that the financial system continues to fulfill its key functions under duress, which is another way of saying creating a stability in the financial system. Now, in contrast to the crisis of 2008-2009, the financial system is part of the solution this time, rather than part of the problem. And this is in no small part due to the fact that financial institutions and policymakers learned some hard lessons from the global financial crisis and used the previous 10 years to put the financial system on more solid foundations. Now, given the wide-ranging and multifaceted nature of these post-crisis reforms, I will not endeavor to use this short introduction to describe the basic features of the transformation of the financial system and of the way in which it is regulated and supervised. I only want to highlight one dimension, the one that pertains to the role of macro-prudential policy in ensuring the financial stability. It is indeed only after the global financial crisis that macro-prudential policy has gained the status that it has now as an indispensable and complementary pillar in the architecture to safeguard financial stability. Next, of course, to micro-prudential supervision, resolution and crisis management. In 2009, the European Commission tasked a high-level group to consider how financial supervision could be strengthened to better protect European citizens and rebuild trust in the financial system. And it advised that supervisory arrangements should concentrate not only on the supervision of individual firms, but also on the stability of the financial system as a whole. The group, chaired by Mr. Jacques de la Rosière, recommended that a union-level body be established with a mandate to oversee risk in the financial system. The European Systemic Risk Board, created by the regulation of December 16th in 2010, is the emanation of this important recommendation in the La Rosière report. The ESRB's mission is the macro-prudential oversight of the EU financial system and the prevention and mitigation of systemic risks. Its remit is very broad, both in terms of financial institutions and markets to be covered. It includes banks, insurers, asset managers, so-called shadow banks or NBFIs, financial market infrastructures, and other financial institutions and markets. Its horizon encompasses the EU member states, Norway, Iceland and Liechtenstein. The ESRB's decision-making body, the General Board, is chaired by the President of the ECB, Christine Lagarde. Now, I'm very happy that Francesco Mazzaferro, who has been the head of the Secretariat of the ESRB since its operational start in January 2011, has accepted our invitation to share with us his views on the financial stability perspective of the COVID pandemic, drawing on the many work streams and policy works that the ESRB has coordinated and overseen since the outbreak of the crisis. Mr. Mazzaferro has been a key observer of the changes in the European financial landscape over the past 30 years, starting his international career in the Directorate General for Economic and Financial Affairs of the European Commission, where his work focused on the European Currency Unit and preparations for the introduction of the single currency. In 95, he joined the European Monetary Institute, which later became the European Central Bank, holding several distinguished positions before being appointed head of the European Systemic Risk Board, which was created in December 2010, as I said, just when Belgium ended her 6 months rotating EU presidency. And as a foreign minister of my country at that time, I very much remember these rather stressed times. But today, we will be talking about yet another crisis. Thank you again, Francesco, for having accepted our invitation. We are now all ears. The floor is yours.
So, dank u, meneer Van Akkeren. Thank you very much, Mr. Vice Governor. I'm very pleased to speak today at this webinar. I have also a personal connection to Belgium. I lived in Belgium, but even most importantly for me and my wife, we married in Belgium, in the Grand Place. So everything which has to do with Belgium has a very nice remembering for us. Now, I will speak a bit about the COVID-19 pandemic, looking at the financial stability perspective. I will start with some comments on what happened in March 2020, but I would like also to comment on the most recent developments, also raising some question marks on where we are, what we know, and what we don't know. Of course, as usual, I have to show this disclaimer. But let me immediately go to the overview. As I was saying, the first part will be on the market turmoil of March 2020. It's a topic which is much discussed also because there is a lot of regulatory work which is going on in these days at the FSB, at IOSCO, and so on to try to address some of the vulnerabilities which emerged 1 year ago. I will try to explain also what has been the, so to speak, humble and limited role which the Esrb had in terms of trying to respond to the pandemic, as we have been using our tools, which are soft law tools, to help authorities to find common ground and, so to speak, also to try to inform each other about what's going on. And then, of course, I will try to speak, as we're saying, about the changing landscape of finance, what is happening almost every day, every week to us, so new episodes of instability, new surprises, and try to raise some conclusions or perhaps some question mark. Now, first of all, I will show you who are, of course, my principals. I had a meeting with two of them just this morning. Christine Lagarde is the chair of the Esrb as president of the European Central Bank. Stefan Ingves, the governor of Riksbank, of the Bank of Central Bank of Sweden, is the first vice chair, and we have also a second vice chair who is the chair of the EBA. As I was saying, our tools are soft law. There are warnings and recommendations which are subject to the act or explain principle. So basically, we cannot, so to speak, twist the arm of anybody, but we have to conquer them with the strength of our arguments. Now, this slide is, of course, obviously very complex and to a certain extent even terrorizing. And why I'm showing it, because this is a slide which has been used by the FSB to try to explain how complex and how interconnected our world is. I will return to it later on to explain what has been our responses to the crisis. But basically, what you see is that the area of activity of the Esrb, which is basically trying to, let's say, cover all those institutions which are among the ultimate borrowers on the left and the ultimate the ultimate lenders, on the other hand, is of course immensely complex. Now, let's try to speak about what happened in March 2020. We had what is called the dash for cash. The outbreak of the COVID pandemic led to an increase in interest risk aversion. It was also obvious. People were seeing that there was a phenomenal collapse of GDP. This triggered a broad-based repricing of risk, like every time there is a real shock. This is illustrated on the chart on the left-hand side. The red line, which you see, shows option implied volatility for the Euro Stoxx equity index. This is an indicator which is very often referred to in the market as the fear gauge. This increase in risk aversion led to an increased demand for safe and liquid assets, but notably cash. This, of course, created an imbalance in demand and supply. And what happened, for example, is some segments of financial and non-financial corporate debt markets became increasingly illiquid. Some of them also, in case of assets which are traditionally super liquid. The dash for cash was accentuated by a sharp increase in payments to be made and received for variation margins on the derivative transaction. If you see again the picture on the left, you will see the blue and the yellow lines, which are exactly the variation margins which are being made and received, and you see how large the shock was. Now, if you turn on the right-hand side, you see the initial margins, which are normally more stable by construction than the variation margins. After all, the variation margins are called like this because they have to variate. But also the initial margins increased sharply. There were ramifications to other markets, and so I was already showing how complex the financial sector is in its own ramification. For example, this chart, which is also, taken from the publication, from the Financial Stability Review of the ECB, shows redemptions by Dutch insurance corporations and pension funds, which, of course, as you know, in your neighboring country are very important. Redemptions from money market funds. So basically, the Dutch investors are a key player in the money market funds market, and they needed liquidity, and they were selling money market funds. The yellow line is the accumulation of net flows, and they are highly correlated with the incidence of net variation margins, which basically creates a connection between two markets, which you would normally say they are not highly correlated. So pensions, insurance fund on the one hand, and the variation margins which are due for central counterparties for CCP. The combination of investor redemptions and deteriorating market liquidity of the assets held by investment funds created liquidity management challenges. And this was not only hitting money market funds, so as I was showing here in terms of what happened with Dutch investors, but also with corporate bond funds. With some of these developments reinforcing each other, and also in a situation in which, by the way, the public opinion and the markets were made extremely nervous by what was happening in terms of the new pandemic hitting our society. There was a risk that impaired market functionings would adversely affect the ability of financial and non-financial firms to raise funds. And this was at a certain time the moment for central banks to enter into action. And this chart shows basically indeed what happened. Central banks worldwide, by the way, not only in Europe, with the ECB and the other central banks, the Bank of England, the Sveriges Riksbanks, and the others. The central banks introduced extraordinary measures. This, of course, included asset purchase programs, special liquidity operations, US dollar funding facilities to restore market functioning, and maintain the efficient transmission of monetary policy measures. These interventions were effective, as you can see from this chart, which shows that there is a world before and after the interventions. This is also taken by publication by the BIS Annual Economic Report. It plots corporate bond spreads against the announcements of some of these interventions, including the ECB Pandemic Emergency Purchase Program, the PEP. In fact, as you can also see in the title of this slide, the Bank for International Settlements called this chapter as a monetary lifeline. Now, let me try to see at this stage what was the initial response of the Esrb to the pandemic. It was articulated in five areas, and I would like to comment briefly on all of them. The first one was the need to establish a strong link between macroprudential authorities and governments, the financial ministers. This was at the time in which governments started to take actions, to take measures. It was important to encourage them to do so. Fiscal policy has been playing a great importance in terms of, let's say, stabilizing the economy. It was also important for us to get information about those measures, and also to try to quantify them. By the way, the website of the Esrb continues to publish on a regular basis a catalog of all the national measures which have been taken, the moratoria, the public debt guarantees, the tax decisions, and so on, to offer to anybody who would like to be informed a global picture of what has been happening. In total, the measures which have been taken by European authorities are very important. They make almost 7% of the GDP. Then we have been looking at the market illiquidity, because, as I was saying, market illiquidity was the third things, and in particular we focused on the need to ensure the liquidity for investment funds, for asset managers and insurers, and in particular for those which had been invested in assets which were at risk from the point of view of liquidity. So, in particular, real estate, investment in real estate, and investment in corporate bonds. And here, the cooperation with ESMA and the supervisors has been very, very important, has been crucial. The dialogue between macro and micro has been extremely, I think, useful and effective. Then we looked at something, and this is the point number 3, which to a certain extent has not materialized, for God's sake. We were very, very worried of the fact that there might be the collapse of the corporate bond market in a situation in which there would be widespread downgrades of corporates and situations even of possible defaults. We knew that there was a very large set of assets which, to a certain extent, were discussed in the market as the possible fallen angels, which were short to becoming non-investment bonds if the credit rating agency had been to drastically downgrade them. So this has not materialized, but also here we have been in dialogue also with the credit rating agencies and with all the national authorities to try to monitor and even to make an assessment of what could have been the possible implications of a severe the severe deterioration of market conditions. The four things which we looked at was to try to reflect on the need to give some clear signs to banks, insurance institutions, even CCPs, other investment firms, on the need to block the payment of dividends and the other distributions, so the share buybacks and the other payouts. Because of the need to preserve capital. So the risk would have been to distribute money at the time in which a few weeks after it might have been this money might have been very precious to make possible for banks to continue to provide credit to the economy. And finally, we looked at the liquidity risks arising from margin calls. As I told you, we have been observing with great attention what was happening at margin calls in the derivative markets, in the centralized clearing activity, and also the interaction between what was happening and the funding of these calls. So how these calls, margin calls, were funded. Who could have been having a problem of being short of having, so to speak, liquidity to pay the margins and finding himself over indebted at the same time. Now, all in all, I have to say that at least for now, the measures which have been taken, but of course also the measures of many other authorities. I was referring to how important the role of fiscal policy has been able to stabilize the market. Now, looking at the previous picture, as I said at the beginning, I mean, what we have been doing, and you can start from the left-hand side. In June, we have been issuing a recommendation on liquidity arising from margin calls. There we have been working over many years, in fact, on CCPs and margins and haircuts with a number of let's say, of analytical and policy products. And turning to the right, we have been issuing recommendation and made the public statements on liquidity risks in investment funds, as I was saying. We have been even writing a letter to EIOPA concerning liquidity risks in the insurance sector, which for years has been to a certain extent underestimated. And also on these years, on these topics, in reality, we have been active for some years to try to see what would be the need of macroprudential policy on insurance and investment funds. And I will finish my presentation exactly on this point, on the need to go beyond banking and try to understand how we can address vulnerabilities in the rest of the financial sector. Now, putting all of this together, much of the Esrb works, both on banks and non-banks financial institutions, has focused on the resilience of the different sectors. For instance, for example, in the work on margin and haircuts on certain parts of the so-called piping connecting these nodes. But the Esrb and the financial stability community more broadly still have some way to go and will fully understand the implications of moving from a bank-based financial intermediation system, which is only one part of this big picture in front of you, to one that relies more heavily on market-based financial intermediation. Or, to put it differently, the changing nature on finance means that entity-based regulation, which is the one which we have. We have a CRD for banks, we have Solvency II for insurance, we have MiFID for some specific markets and so on. It may mean that entity-based regulation may not suffice when entities engage in a broad range of sometimes overlapping activities. And let me go now to the second part of my presentation, which is exactly on the changing landscape of finance. And this changing landscape of finance is something which is basically we are observing day by day, hour by hour. it is the product of technology, it's product of search for yield, of also of entrepreneurship, of course of people. And to a certain extent, what we are now seeing is a number of episodes, and I will excuse myself for you if I will now speak only on things going wrong, but to a certain extent, this is a bit in the nature of my job. We see a number of different episodes, like they were snowflakes. You know, snowflakes are in reality all different among each other. No. And over the past few years, we have seen a number of events, some of which very, very surprising, that were all different, but at a certain time, they might have had something in common. So let's briefly recap on what have been happening in this year. So early in 2021, there was GameStop. So GameStop was a US video game retailer. The stock price rose sharply without any fundamental news about the firms. This was causing large losses at some US hedge funds who had short position. Now, looking at what happened, this sharp rise was related to a large number of investors, to a large extent non-professional investors, purchasing exposures to the companies and discussing their investment on social media. Investors also gained exposure by purchasing call options on the stock. As the stock went up, short sellers had to cover their positions, amplifying the price move. One US hedge funds faced very large losses, requiring a private capital injection of $2 billion of US dollar. As trading activity and volatility jumped, brokers had to post additional collateral to CCPs, also reflecting one-way trading dynamics. Some brokers had to receive capital injections and impose temporary trading restrictions on the stock. So, in non-technical terms, it was a real mess, which nobody could expect, because it was the result of, so to speak, small investors creating a coalition using social media and being able, so to speak, to beat hedge funds, putting them on their knees. This March, there was Archegos. I've never been clear what is really the right pronunciation. I hear people saying Archegos, people saying Archegos, so I will say Archegos, Capital Management, a US domiciled family office, also something which you learn when crisis happens. And this Archegos was unable to meet variation margin scores on highly concentrated and leveraged positions on a few US and Chinese stocks. This led to large losses at some prime brokers on their hedges. Now, Archegos, in reality, have been able to obtain high exposures on the underlying stocks by using synthetic leverage and enter into similar swaps transactions with multiple brokers, each of which did not know about the others. So, it was a situation in which Archegos was the mid, had taken an enormous bet. All the others have been providing liquidity to Archegos without knowing that Archegos was not only exposed to them, but to other players. When the stock prices started to fall, variation margins call had to be met. The counterparties were forced to sell their hedges, which caused a sharp price fall, more than 50% for some stocks, and led to large losses from prime brokers, including non-US banks, in particular, as you may know from the press in Switzerland, as these non-US banks were perhaps slower to reduce their positions. Still in March, so we are things happening, so to speak, in a very short time. There was Prudential. Prudential was a UK firm specialized in supply chain finance, which filed for insolvency. There were ramifications for some banks, investment funds, and insurers. Now, what Prudential was doing was to acquire trade receivable from suppliers at a discount, and then recoup the payment from the clients. Those purchases were funded by a German bank, the Prudential Bank in Bremen, that belonged to the group, and some of the receivable were repackaged into notes sold to investment funds, with additional credit guarantee provided by insurers. So you see the entire set of the map of the financial sector there, provided by insurers, by the way, notable insurance in Japan and in Australia, to reduce credit risk. In March, the bank supervisors froze the assets of the bank due to the suspicion of balance sheet manipulations, while in 2020, some insurers refused to renew in Japan and Australia the guarantees of the bonds due to increased concerns about the ability of clients to pay the receivables. Such events led to substantial valuation issues, which resulted in the suspension of redemption for 8 EU funds. And then, once again, last year there was a Wirecard, but we may probably have heard about it. There was a case of accounting fraud that resulted in the insolvency of the firm and losses for a number of banks. And then in 2019, we had H2O and Woodford equity income funds. So these were investment funds which have invested in liquid securities and needed to take measures when faced with large investor redemptions. While none of these idiosyncratic events in 2019 led to the materialization of systemic risk, they occurred during stable market conditions and illustrate key vulnerabilities. Now, I spoke of snowflakes, and you know, snowflakes can produce different outcomes. So on the left, you see a snowman, and on the right, you see an avalanche. So snowflakes, and we have to decide on whether in which scenario we are. Snowflakes can turn in different things, and we have to understand what might come next. And we have also to understand whether there are common themes about all these episodes. Now, one thing which is in common to many of them, not all, but many of them, is that they are all trying to take excessive risk. Certainly, it's probably not true for Wirecard and where there was a real problem of criminality, of GameStop, or where there was a problem of people playing with the social media. But all the other cases, there was indeed an attempt an attempt to search for yield, which to a certain extent is also something which is structured in a situation in which the low level of interest rates is predominating everywhere in the world. But this is not the only story. Is why we didn't see these things happening? Why many of these things were really a surprise for us? So what is the blind spot? And here, what you see is that things are being falling between the regulatory cracks. And I'm staying here in this winter theme. So as finance changes, things become blurrier, and certain activities can be less neatly allocated, and the categories under certain entities are vanishing. For example, as a technology company, Wirecard was not considered a bank, was not considered a financial institution, and for this reason was not primarily supervised by a bank supervisor. And this, of course, created the situation of a big surprise. As a family office, Archegos was considered as a strange animal, if you want, but it would have probably not been considered if it had been in Europe as an alternative investment fund manager. So it would have not been part of the EFMD. Likewise, on the contrary, an hedge fund would be an AFMD. In other words, much of our regulation is still allocating firms in boxes, but And we have these entities-based regulation, but we have a number of cases, and we have seen some of them, where we cannot allocate firms as neatly between entities for many reasons. New business models, new technology, which makes possible to provide services which in the past would have not been provided. Possibility to enter into a range of activities also due to technology, which are to a certain extent worldwide, also for companies which are not need to be, so to speak, super large like it was happening in the past. In the past, to be present in Australia, Japan, in the entire world would have been required an organization and a size which would have been much larger than today. So I think what we have to learn from what Daniel Tarullo, was a previous member of the board of the governors of the Federal Reserve, has been telling us in a fascinating recent paper, which I would really recommend to all of you, which is entitled Congruent Financial Regulation. In it, he argues, and I quote, that the regulatory structure is incomplete, and then incompleteness, that is the incongruence, leads to risk shifting and the creation of alternative pathways of financial intermediation that are neither planned nor optimal. End of the quote. Now being now to finish, if you want, the winter seasons of the slides, and as we are in a more summerly picture, even if I have to tell you that in the last weeks, I think in Frankfurt we are more in a monsonic season than in spring. I would like to make a reference to the need for a regulatory Duct test. Maybe we are missing regulatory modification of the. We need some. Maybe we need some common sense judgment. By this I mean that even if something looks like a duck, swims like a duck, and quacks like a duck, we do not necessarily need to conclude that it is a duck. We have to reflect on how to treat it. To use again the words of Daniel Tarullo, and I'm quoting, the regulation of economically similar activities would be coordinated across agencies with the goals of minimizing regulatory arbitrage and ensuring that the social cost of systemic risks are internalized by private actors, regardless of their institutional form. To achieve this, it calls for the regulation to be congruent, not necessarily identical. And this is a very important distinction. Congruent regulation makes use of economically similar but not identical instruments with regulation coordinated across agencies. Now, this has been an important part also of our mission. We have been publishing already in July 2016 a macroprudential policy strategy on how to bring macroprudential policy beyond banking. This is an important mission which remains with us. It's been a commitment of all the chairs of the Esrb, of Trichet, Draghi, and Madame Lagarde, and this puts us to a certain extent completely in line with what Tarullo has been telling us. Now, I've been speaking 40 minutes. I hope it was interesting, and I'm, of course, ready and willing to take any comment on my presentation. Thank you very much.
So, thank you very much, Mr. Mazzaferro, for your very extensive overview of the activities and the concerns of the ESRB. The ESRB is perhaps not the most well-known institution, but it is certainly not the least important institution in our financial system. Indeed, it was a pity that we could, for technical reasons, not show the feed with your image, Mr. Mazzaferro.
I'm here now.
But as we announced, there have been posed, yes, about 10 very relevant questions. And I want to address a few questions to you, if you agree. So perhaps a first question about someone who is very concerned about dividends. The ESRB has recommended restrictions on bank paying dividends during the COVID crisis. Do you think that dividend restrictions are a useful tool beyond the COVID-19 crisis? Can this tool be improved or moderated? What is your opinion about that?
So, first of all, of course, you understand that I'm not able now to make any announcement of what we will go to do beyond the recommendation of the Esrb, which expires in September. But I would like to say a couple of things in general terms. First, I think it has been pretty useful. If we are going to see what has been the increase of the capacity of the banking sector to lend, in very difficult conditions, part of this has been due to the fact that the banking sector was able to conserve capital. And the fact of giving a clear message, which has been given not only by the Esrb, but has been given also by the EBA, by the SSM, by EIOPA, all of this has been protecting not only the banking sector, but also insurance and other players from risks of, so to speak, of finding themselves, as was saying, without ammunitions. That's now, one of the issues which we will have to discuss is the following. We have been activating recommendations. So we have been recommending other institutions which have been recommending, and so on. All of these perhaps needs some more direct instruments. I don't think it should be the Esrb to have direct instruments on private companies, but the micro-prudential supervisors should have more powers. Should have more powers in a situation in which, of course, they will have to be, so to speak, reliable, and there should be a clear need to explain to the political system. Accountability is absolutely important, this type of things. But at the very end, they should have more tools in the future on the possibility to intervene on dividends.
Thank you. A second question, 2 times even. Does the ESRB evaluate the risk associated with digital assets like Bitcoins and Ethereum and other digital assets?
So the Esrb has not been specifically doing this work because one of the fundamental rule is that we should, to a certain extent, also divide ourselves the work among different activities. Otherwise, there is a huge overlap on who is doing what. But this is, of course, an area of increasing concern, and I would say the international level. So the FSB is extremely active on these things, and it's clear that this is becoming a world which is very, very complex. It's very complex, not only because of the volatility, the instability of these assets, but also because the interaction between their nature as IT completely based tools and the risk which could come from cyber. We have now in a world in which we are seeing things which in the past would have been difficult to think. So we have a sort of Corsair war played by, so to speak, private players. We have seen what has been happening recently with an attack of a criminal group on the Continental Pipeline in the US. So imagine an attack of this nature on cyber assets and what would have been or what could be the loss of value for those who have been investing there.
So thank you. A question on the non-performing loans. So while the banks have not yet seen non-performing loans rise, thanks to the moratoria and the public support, how do you assess the risk of a serious increase in non-performing loans in the coming months when support measures will be dismantled?
Well, first of all, we have to say that we think that the banking sector is much stronger than it was in the past. No, and Vice Governor Van Acker has been referring to the fact that by learning the tough story, banks have become much stronger. So from this point of view, we would not see in the current situation the risk of a large systemic, let's say, crisis coming from non-performing loans. Also because there's been a very strong, action taken by institutions and to try to prepare themselves. Nevertheless, it's very important that banks make their job well, that it's very important to provision. It's very important to provision, it's very important to classify the loans accurately. And then, of course, one has to continue to be vigilant because we don't see NPLs, but of course we see that there is an increase in stage two credits, which basically means that something, of course, in the economy is going to happen. There have been losses. These losses now, I think, are probably very diverse from country to country, also on the basis of commercial specialization, economic specialization. We do not have a general collapse of the corporate sector, not at all. And so it's very important from this point of view that whoever banks remains very vigilant on some segments of the economy.
Yes, we received a quite similar question with a focus on the public debt. So the question is as follows. Public debt has increased a lot because of the COVID crisis. Debt levels are much higher now than in 2010. Do you think the COVID-19 crisis will trigger or risk to trigger a new public debt crisis as we have seen in the past?
I think a lot will depend on what will be the strength of the recovery. At the very end, the debt which has been created for different reasons than the past. And now we have to see what will happen in terms of the recovery. And if our countries will be able to let's say, to grow fast and faster than it has been in the past. So the very important was referring to fiscal policy. It's very important that governments are activating policies which are facilitating growth. So if this happens, and we hope that to a certain extent, at least there is an attempt of doing this, then it will be also easier to reduce the debt to GDP ratios.
So thank you. A more, perhaps more specialized question on the financial architecture, on the supervisory architecture. Do you think, Mr. Mazzaferro, that the coexistence of different supervisors within the financial supervisory architecture will enhance the risk of incongruence in the concrete application and the interpretation of the regulatory framework?
Look, this is a never-ending story because Normally, these things changes only if there is a catastrophe, no? So regularly, so you start to say that if there is a catastrophe, and then you make a twin peak. Then there is another catastrophe, and you the difference, and you make the single supervisor. Then there is another catastrophe, and you divide them by 3. So I hope that there will be no catastrophe, and the situation will remain like it is.
Yes, thank you. A question referring to your conference. You mentioned the risk posed by the snowflakes within the financial system, but there are also tail risks coming from outside the financial system, such as the pandemic. Does the ESRB monitor or tries to monitor such tail risks, and how should they do it?
Yeah, I think this is to a certain extent our bread and butter. Now, not from the point of view, if you want, of the virologist, because this we do not have this competence. But if you were, so to speak, in a mosquito in the room of where we work, you would discover that we speak only of things going catastrophically badly. There is no discussion on things going well, because the discussion, if we discuss about things going well, means that we are not doing for what we are paid for. So yes, we are looking, I mean, these hybrid risks, which are, I would say, technological risk, geopolitical risk, climate change risks, and this type of things are becoming more and more important. And by the way, they also require a capacity of all of us to cross among cultures, among disciplines, to try to understand new languages and try to understand what could be, so to speak, the vulnerabilities and the threats of the future.
So I have a few questions left, and we have indeed about 5, maximum 10 minutes. A question about asset bubbles. Are you concerned in the post-COVID period about the rebound of the economy creating asset bubbles? And where do you see a risk of asset bubbles?
Well, we have been issuing recommendations on the real estate, and we are continuing certainly to look at real estate. Now, real estate, by the way, is very diverse, country by country. Real estate is also very different in what is residential and commercial. If you are speaking about the COVID, by the way, the impact on residential and commercial has been very different. Residential, what you have is a boom in pricing, because now everybody would like to live in a castle, having on the first floor the home office, and the second floor, let's say the cinema, the private cinema in which you will work, for which you will work, so to speak, during the coffee break, and on the roof, the terrace to take the sun. On the other hand, commercial real estate is hit because of the need of less space. I think, I don't know what has been the impact, but the announcement in Brussels that the European Commission is halving the number of buildings must have a local impact on commercial real estate prices in Brussels, because of course the Commission is a very large, local is a very large institution. So if all the institutions were now, imagine that all the federal, regional, and the community institutions in Belgium decided to halve the use of offices. Well, in a place like Brussels, it would mean that you have a very large number of, so to speak, of objects which are under discussion. And then, of course, there is also the impact for commercial real estate on the fact that people are getting now packages by Amazon and this type of things. And so also the way in which you're approaching yourself to buying has been changing. So this gives you only and it's not only this, it's much more than this. But it is obvious that in an age of changes, you have always to reflect on the level of prices. Are they too high or too low?
So thank you, Mr. Mazzaferro. I have two questions to conclude. One concrete question about capital buffers and another about a policy advice. The first question, in the COVID crisis, supervisors have relaxed capital buffers to give banks room to provide credit to the real economy. Do we know or do we monitor whether this relaxation of buffers is working and has worked?
No, look, this is a topic on which a lot of work is being done, including, by the way, I know very well in Belgium, because your colleagues at our table are exactly explaining what they are doing. So there is a lot of monitoring. There is also a lot of questions mark which we have is whether the current framework is completely, so to speak, delivering what we would like to have or not. Having said that, the issue is incredibly complex. So it is easy to start with the question. The answer is of such a degree of intricacy that I would even not try to answer here.
So thank you, and I want to conclude this Q&A session with the question of 1 million. What will be your priority advices to Belgium in order to strengthen financial stability?
Oh, this I don't know. Honestly, I was not prepared for this question. I think what I would say in general is what I would say to everybody. So we have a very good framework for cooperation. It's very important that we use it as much as possible, and I think we are doing it. So as much as possible, exchanging data, information, try to inform ourselves, try to learn from each other. As I was saying, there are things which are happening almost every month which are taking us by surprise. And honestly, I think it will continue like this. So at the very end, it could be an immense collection of snowflakes, like it could be a bigger problem. And the key issue is to stay in contact and to have a very permanent and strong dialogue.
So thank you very much, Mr. Mazzaferro. Dear speaker, dear participants, with this last question, I want to conclude this very interesting webinar. Mr. Mazzaferro, we were very happy to have you with us.
The same for me. Thank you very much
for your
explanation,
your extensive overviews, and your very honest and very direct answers to our questions. Those questions were very, very interesting, which is showing, of course, the interest for this kind of webinars. To our public, thank you very much for your participation. We like to see you again on one of our next webinars. And as usual, you will get the invitation in your mailbox. Thank you very much, and I'd like to see you next time. Bye-bye.
Bye-bye, tot ziens, au revoir.
Thank you very much. It was very insightful.
Thank you. Bye-bye.